Why are there not more people talking about the credit process cycle? What's up everybody, it's Amjad, and welcome back to the channel. Today, we're diving deep into something that's absolutely crucial for your financial well-being, the credit process cycle. Whether you're thinking about buying your dream home, getting that new car, or even just trying to rent an apartment, understanding how credit works is absolutely essential. Now I know what you're thinking. Credit can seem super complicated and intimidating, but trust me, it doesn't have to be that way. Today we'll walk you through each step of the credit process cycle, breaking it down into bite-sized pieces that anyone can understand. We'll uncover the secrets behind credit scores, loan applications, interest rates, and everything in between. By the end of this video, you'll have a rock-solid understanding of how the credit system works, and you'll be equipped with the knowledge you need to make smart financial decisions that will benefit you for years to come. So buckle up, grab your notebooks, and let's get started. You need to hear this if you're a first-time borrower. Alright, let's kick things off with the very first stage of the credit process cycle, credit origination. This is where it all starts, the moment you decide to borrow money or use credit. Think of it like applying for a credit card or going to a bank for a loan. During this stage, lenders like banks or credit card companies want to get to know you, your financial history, your income, your ability to repay. They'll ask you to fill out applications, provide documentation, and basically prove that you're a trustworthy borrower. This is their way of assessing the risk involved in lending you money. I bet you didn't know how crucial the credit evaluation process is. Once you've submitted your application, the lender moves on to the next crucial step, credit evaluation. This is where things get interesting. Lenders aren't just going to hand over money without doing their homework. They want to make sure you're good for it. To do this, they'll dive deep into your financial history, checking your credit score, your payment history on past loans, and even your debt-to-income ratio. They're looking for any red flags that might suggest you're a risky borrower. Think of it like a financial background check. This is why you need to understand the credit approval process. Okay, so you've applied for credit, the lender has scrutinized your financial history, and now comes the moment of truth. Credit approval. This is where the lender decides whether to approve or deny your application based on their evaluation. If your credit score is good, you have a stable income, and your financial history checks out, chances are you'll get approved. But if your credit score is low, you have a lot of debt, or there are some negative marks on your credit report, you might get denied or offered less favorable terms. Why are there not more people talking about the importance of credit administration? Chapter 4. Credit administration, keeping things in check. Congratulations, you've made it. Your credit application has been approved and you've got access to the funds. Now comes the credit administration phase. This stage is all about managing your account and making sure everything runs smoothly. The lender will set up your account, generate statements, collect payments, and basically handle all the behind-the-scenes stuff. It's important to stay organized during this phase, make your payments on time, and keep track of your spending to avoid any potential issues down the line. You need to hear this if you're a borrower looking to improve your credit. Chapter 5. Credit relationship management. It's a marathon, not a sprint. Credit isn't just a one-time transaction, it's an ongoing relationship between you and the lender. That's where credit relationship management comes in. This stage is all about maintaining a healthy credit relationship over the long haul. Lenders might offer you additional credit lines, adjust your interest rates based on your payment history, or provide you with financial advice. They want to keep you as a happy and loyal customer. It's like any relationship, communication is key. Chapter 6. Credit recovery, navigating tough times. You need to watch this if you struggle with managing your credit during tough times. Let's face it, life happens. Sometimes unexpected events can make it difficult to keep up with your credit obligations. That's where credit recovery, also known as debt collection, comes into play. If you miss payments or default on your loan, lenders will take steps to recover their funds. This might involve contacting you to work out a payment plan, assigning your debt to a collection agency, or even taking legal action. It's crucial to communicate with your lender if you're facing financial difficulties. You need to hear this if you're a borrower. Now let's talk about the nitty-gritty of credit pricing. When you borrow money or use credit, it's not free. Lenders charge interest rates and fees for the privilege of using their funds. These interest rates and fees can vary widely depending on factors like your credit score, the type of loan, and the overall market conditions. It's essential to shop around. compare offers from different lenders, and understand the total cost of borrowing before you commit. Security and collateral, protecting the investment. To mitigate their risk, lenders often require some form of security or collateral when you borrow money. This acts as a safety net for them in case you're unable to repay the loan. Collateral can be an asset like your house, for a mortgage, your car, for an auto loan, or even your savings account. If you default on the loan, the lender has the right to seize the collateral to recover their losses. It's a serious consideration when taking on debt. Are you worried about your loans becoming non-performing? Chapter 9. Prevention of non-performing loans. Staying ahead of the game. Lenders don't want you to default on your loans. In fact, they go to great lengths to prevent loans from becoming non-performing. They use sophisticated risk management techniques, data analysis, and predictive modeling to identify potential borrowers who might struggle to repay. They also educate borrowers about responsible credit management, offer financial literacy programs, and provide support to help borrowers stay on track with their payments. It's a win-win situation for both parties. Chapter 10. Code of Conduct and Ethics on Credit Playing by the Rules. Finally, let's talk about the ethical side of credit, the Code of Conduct. The credit industry is heavily regulated and lenders are bound by strict rules and ethical guidelines designed to protect consumers from unfair lending practices. These guidelines cover everything from discrimination to transparency in fees and interest rates. It's essential to be aware of your rights as a borrower and to report any unethical behavior to the appropriate authorities. Why are there not more people talking about mastering the credit process cycle? Thank you for joining us on this journey through the credit process cycle. We've covered a lot of ground today, from the initial application process to the importance of ethical lending practices. Remember, knowledge is power, and understanding how credit works is essential for anyone looking to achieve financial freedom. We hope this guide has provided you with valuable insights into the complexities of the credit system and empowered you to make informed decisions about borrowing and managing your finances. If you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more insightful content. And as always, feel free to share your thoughts and questions in the comments below. Until next time, stay informed, stay smart, and keep building that bright financial future.